Price earning ratio. Now, when we talk about a price earning ratio, we are looking at the relationship between the earnings of a share in comparison to its price. So what the share stands to benefit from the business's activities vis-a-vis what one will get when he or she sells it off, or what one is supposed to pay to lay hold of the share. This will tell the length of time that it's going to take a business to pay off the shares. Now, the significance of a price earning ratio is that it helps investors to make wise decisions. If a business has a price earning ratio which is within your comfortable level, you can go in with it. It can also help investors to determine whether a business is having some financial challenges or will be having difficulties in paying the returns on their shares. Secondly, it will help to analyze if a share is underpriced or overpriced, because if the earnings of a share is lower than its price, it means that the price should come down, and vice versa. The challenges with this ratio is that cash flow would have been a better indicator than the profits being used. And secondly, it is not a good indicator of future performance. The fact that you are generating more now to succumb the price doesn't mean that that trend will continue in the future. Or the fact that you are suffering now doesn't mean that you will not be able to bounce back. So the formula is the price per share divided by the earnings per share. So if you want to know how to calculate the earnings per share, just click the link above and get yourself conversant with it. So the price per share is the market value of the share at the point of the calculation. This might differ within the period. So it's ideal you pick the prevailing one at the point of calculation. Now, the earnings per share is the total earnings or the profit for the year of the business divided by the total number of shares also at the end of the year or at the point of the calculation. So as with all ratios, it must be compared to a prior year of the same business, a chosen competitor, or a metric set by the industry. When that is done and it is higher, it means that the share's price is higher than what it will earn. The investors are paying more than what they stand to derive as benefits. Okay. Now, this relates to the assumption that the share is overpriced because what you are paying for does not match what you are going to receive. Now, investors will be paying less for the share because your earnings is lower than the price. So there's no motivation to encourage investors to pay more or rush for the shares. Lastly, investors will be expecting the business to grow to be able to at least give them something closer to what they are paying. That is what every investor will be looking out for. However, when that is done and it is lower, it means that the share price is lower than the earning. And that is some good news for investors. Also, the share price is undervalued. If the earnings is more than the price, it means that it's going to force the price to go up because everybody will want to have an ownership of such a share. So investors will be paying more for the shares because it is an enticement. It's lucrative. You are generating more returns on the shares than it is currently being sold for. So people will rush in for it. Now, this is some sort of an effective delivery by the business to be able to generate more profit to outshine what people are supposed to pay for. Let's test understanding. Now, Tesi Incorporated operates in the oil industry. The market value of its shares is $500. Its average monthly earnings per share is $45. The price earning ratio for the oil industry is 10. So we have to calculate and analyze the price earning ratio. For solution, we'll state the formula, which is the price per share divided by the earnings per share. The solution is going to provide an answer of 11, which is more than the industry set 1. This is as a result of dividing the $500 of the price of the share, which is the market value, by the earnings per share, which is the $45.